We're going to take a look at the Eurobond market, one of the biggest debt markets in the world, used day in, day out by companies and also governments, and a classic piece of financial markets jargon. There's a lot of confusion around what Eurobonds are and who issues them and why. So we're going to use this video to clarify some of the jargon and also explain how one of the biggest markets in the world works as a kind of beginner's guide. Now, one thing to get out of the way, and this is very confusing. Typically European politicians are confusing everybody at the moment. This is not a video about the Eurobond. It's a video about the Eurobonds markets. Now, in case you're thinking what's the difference, politicians in Europe have chosen to call their latest project, which is an attempt to consolidate the debt of both the creditworthy countries like Germany and the less creditworthy ones like Portugal and Greece. They're trying to consolidate all those debts into one sort of lump, if you like. So replace each country's individual borrowings with one big European bond, and they've chosen to call that the Eurobond. Now, you might think that's a perfectly sensible name for it until you realise that long before they came up with any of that, there was a separate Eurobond market. So anyone confused by what the Eurobond is, forget that for this video. We're going to cover that in another video. Today we're going to talk about the long-standing Eurobonds market. And the first thing to say about it is that the name is a little bit misleading. Bonds is a good name because this is a market where companies and governments can issue IOUs that pay interest and have to be repaid at some point, so it's a way of borrowing basically. But Euro is a little bit confusing because we'll see as we go through that a Eurobond, by its standard old definition, nothing to do with what European governments are doing right now, by its old definition, Eurobonds don't necessarily have to be issued in Europe. They can be. They don't necessarily have to be issued in the euro currency, but they can be. So it's a slightly misleading term in some respects. So we're going to clarify what it means and why Eurobonds exist. Now, first off, anyone wondering what a bond is, let alone a Eurobond, should probably watch my bond basics video, and that'll explain what bonds are. This video is going to focus on a particular type of bond and a very commonly issued type of bond. And don't forget that a bond is just an IOU issued by a company or a government, so investors buy them. So effectively investors become lenders by buying these bonds, and they expect to receive an interest rate from the issuer. Often it's a fixed rate of interest, and obviously at some point the issuer will have to repay the outstanding loan. So think of it as a tradable loan, and as I say, have a look at my bond basics video if you're not sure. Right, the objective is what, before we dive in? It is basically to borrow as cheaply as possible. So if you're issuing Eurobonds, there has to be a reason, because they're a bit more fiddly than standard bonds, and that reason is going to be I need to borrow cheaply as a company, and I reckon Eurobonds is the way to do it. Or maybe I'm trying to tap a market that I wouldn't otherwise have access to, and that might be another reason why Eurobonds exist. So those are the main two motivations for now. Right, so let's start with some jargon. So imagine I'm a company in the UK. And what I'm looking to do is issue an IOU. I need to borrow money. Okay, so maybe I want to set up a new business, buy some assets, I need to borrow money. So I'm thinking about doing a bond issue. I could just go to the bank and get a bank loan, but if I'm a big enough company, a bond issue will work out cheaper, partly because bonds can be traded on by investors. So they generally carry a slightly lower interest rate. So I'm going to go for a bond issue of some sort, try and sell paper to investors. So what are my options? Well, the most obvious way of doing it would be, let's say, to issue in sterling in the UK. So what I do with the help of an investment bank or similar is I create these IOUs in sterling and I sell them to UK investors. Who would those investors be? Not typically your kind of Tim Bennetts, your retail investors. They would tend to be large pension fund type investors, institutions. So that would be what is known as a domestic bond. That's not a Eurobond, but it's not a bad place to start. That would be called a domestic bond issue. It would also be a domestic bond if the company was American, and the bond was issued in dollars this time, and it was sold to American investors. Or if the company was Japanese, the bond was in yen and it was being sold to Japanese investors. Those are all examples of what are called domestic bonds. So the three key components, all the same. The issuer, the key currency, and the people buying it, all kind of from the same jurisdiction. Okay? Now, that doesn't sound very exciting, and it's not. That's just a plain vanilla loan issued in the home market. So let's spice things up a little bit. As a UK company, could I issue a bond in dollars and sell it to US investors? Now the answer is yes. I suppose the first question is, why on earth would you want to do that? If you could issue bonds in your own currency, why would you go to the American market and issue bonds there? Well, the obvious answer would be, maybe I want to buy assets in the US, I want to set up a business in the US, and what I need to do is hedge the assets, which will be paid for in dollars, against the funding that's going to pay for them. So in other words, I want them in the same currency. So if I issue a sterling loan to buy dollar assets, that doesn't sort of quite work. So what I might want to do is borrow dollars in the US market and use them to pay for the stuff I need in America. So these are known as foreign bonds. Now, bond traders being what they are, they don't like to have to say every single time they're describing one of these things, this is US debt being issued in the US by a non-US company, in this case a UK company. But it could be a French company, it could be a Japanese company, but the point is, somebody is tapping the American markets, approaching US investors for dollars, but they're not a UK borrower, a UK firm. And these are the ones that are given shorthand nicknames. So a non-US issuer trying to borrow in the US markets creates what's called a Yankee bond. Spin it round, a non-UK issuer coming over to the UK to borrow sterling creates a bulldog bond. And you probably get the idea, you've probably got an insight into the mind of a trader now. So if you're a non-Japanese company borrowing yen in Japan, you create what's called a samurai bond. If you're a non-Australian company borrowing Aussie dollars in Australia to fund an Australian operation, for example, that's called a kangaroo bond. So foreign bonds are the ones that attract the often the quite silly names, kangaroos, bulldogs and so on. It's just a faster way of saying, in the case of a Yankee, this is a non-American company borrowing dollars in the States. Now, Eurobonds. These are the strictly, completely international bonds, because there's a key here, okay? Dollars in the US, well, dollars are normally in the US, okay? Most sterling is in the UK. Most yen are held in Japanese accounts, but not all of them. Now, I'm going to be a bit flippant here, but at home I have some euro sitting on my coffee table and some US dollars. Strictly speaking, I could lend those dollars and those euro to someone and charge them an interest rate for it. That would be lending dollars that are not in America, or lending euro that are not in the Eurozone. They're on my coffee table in Clapham. All right. Now, those currencies sat outside their home country are known as euro currencies. I'll say that again, because euro can be confusing. The dollars on my coffee table and the euro on my coffee table are known as euro currencies. A euro dollar is a dollar not parked in an account in its home turf, if you like. So dollars are held in accounts all over the world. Okay, not in as bigger quantities as they're held necessarily in America, but nonetheless, dollars are held all over the world. And a dollar sitting in an account somewhere that's not America, if you want to see it that way, is known as a euro dollar. Now, here's the point. A euro bond taps those currencies. It is somebody trying to borrow and targeting those currencies, those piles of euro dollars. And that's what creates the Eurobond definition. It's the idea that maybe you could have dollars sitting somewhere other than the US and targeted by, say, a UK company. So let's take an example. So you've got a UK company, okay, it's decided it wants to borrow in dollars, but it's going to raise those dollars somewhere that's not the US debt markets, okay, and that is actually perfectly possible. Or maybe it's going to raise some in the US and it's going to then again raise some of them somewhere else in Europe. So let's say in the Eurozone. Okay, So what you've got is, if you like, you've got a complete mix-up. You know, all three components of the bond are different: the issuer, the currency, and the place where the money is being borrowed are all mixed up. All right, but actually, the principle behind Eurobonds is that they're based on euro currencies, and euro dollars are dollars sat anywhere in the world that's not the US. Okay, and you can have euro yen. That gets a bit confusing. Euro yen does not mean yen in Europe. Okay, all it means is yen. It's a catch-all phrase for yen on deposit outside Japan. Okay, so that creates a euro currency. It's simply a sort of a catchphrase. Now, why, given it could be any country in the world and any currency, why call it euro anything at all? Because isn't that confusing? Well, that goes back to the history of these things. The first Eurobond issue is debated, frankly. No historian, I don't think, can actually say that was the first Eurobond issue. But a few people think it was the early 1960s, Autostrada, that's an Italian company looking to raise dollars and finding it cheaper to do so in Europe, or approaching London's bankers to arrange that deal. Some people think that was the first one. Other people point to the Russians after World War II, needing dollars for reconstruction and not wanting to ask the Americans, for sort of obvious reasons, I suppose. So going to Europe to organise it. So that kind of European badge stuck, but it doesn't matter. Basically, a Eurobond is based on a euro currency, and a euro currency is any currency not on deposit within its country of origin, if that makes sense. So any currency can be a euro currency, in theory. You can even have euro. Okay, enough about that. Now then, what's the point? Okay, I mean, why would you ever want to do this once you've got the kind of jargon out of the way? The answer is it's quite common. Let's take a situation. So what would be the point of having these Eurobonds? And what I don't want to do is to go too much off-piste. What I mean by that is I'm going to have to use another word, swap, in a moment. And I do have another video on what are swaps. Okay, so if you want to know more about that bit, don't expect me to blather on here about swaps too much. This is on Eurobonds, but do feel free to watch that other video. So, set of circumstances. So I'm a US company, and I want to operate all over the world, and I decide one of the countries I want to operate in is Thailand. Okay. All right. Clearly not a company selling dictionaries, the way I've spelt that, so that says Thailand. All right. Now then, I want to set up a subsidiary in Thailand. So I want to set up a what they call a subsidiary, an operation in Thailand. All right. Now, what are the options here? Well, I'm going to need to raise some money potentially. So this thing's got to be funded. So yeah, by all means, basically the subsidiary over in Thailand could issue its own debt. All right. It could. Having set itself up just outside Bangkok, needs financing, so it could raise Thai baht denominated debt in the local market. Okay, but here's the point: that might be quite expensive. This company isn't known in Thailand, and this is even assuming they can do that. It even assumes they can get access as a US company to the local Thai bond market. All right, so I'm making a couple of assumptions here: is can they do it at all? Now the answer might be yes, but can they do it cheaply? And the answer might be not as cheaply as it can be done another way. So how about this? That may not be very cost effective because their credit rating as a little company isn't that good, because they're not really well known, they're just getting established. But this company, the parent company that wants to organise this in Thailand, is a big monster well-rated company. So maybe, for example, the US company borrows baht because it's got a much better credit rating, all right, so it can borrow on cheaper terms, and then basically organises an internal loan to its subsidiary. So the subsidiary doesn't have to tap the local debt markets directly at all, because the parent company raises the money using its much better negotiating skills and bigger credit rating, and then organises an internal loan. All right, so now here's the question: where is this US company going to borrow baht from? Yes, the US company could go to the Thai market and issue bonds, but it might not have to. It might be able to do a deal cheaper somewhere else, because The Thai currency is held mostly in Thailand, but there are deposits elsewhere. So the point is, a Eurobond could be a way for a US company, okay, trying to set up a subsidiary in Thailand, not wanting to tap the local debt markets through the subsidiary, which would be the obvious thing to do, you might say, because there is a cheaper way for it to achieve the borrowing. So essentially, it borrows baht, cheaper than the subsidiary could do, organises an internal loan, and then effectively the subsidiary pays interest back to the parent, and the parent pays interest onto the external investors. So that'd be one way of potentially organising the whole thing, and it might involve a Eurobond issue over here somewhere. Okay. Other reasons Eurobonds are issued is to do with bringing down the cost of borrowing. Companies are always looking for the cheapest way to organise borrowing. So for example, it might be cheaper for a company because you can saturate a market. You can borrow and borrow and borrow and borrow, and eventually your American lenders get a bit fed up with you. They're just not prepared to lend anymore. So what you might do is go somewhere else. You're looking to borrow dollars as a company. You think, well, actually, I'm up to the limit really in the American market. I'm running out of people to borrow from, but I'll go to Europe instead. So you tap the European market. Again, it might be you tap the European market for a different currency, the euro, and then swap it into the currency you need, US dollars. So you end up doing a sort of a Eurobond issue, all right, and you then swap the currency that you don't want into the currency that you do. This is not a video about swaps, but there is another video on interest rate swaps in my collection. Okay, so basically Eurobonds are all about organising the cheapest way for a company to arrange its borrowings in markets where either it would struggle to raise capital at all, or it could raise capital, but the Eurobond issue offers it another way of doing it. Now I'm going to finish on a few, if you want, admin points. So first of all, who issues Eurobonds? Can be a bit of a palaver. You can imagine you've got lots of currencies involved, lots of different types of investor involved. It's kind of an international issue, so the sums tend to be large. Think $50 million upwards. That's a rough rule of thumb. So this is a market for big issuers, so the issuers tend to be big companies, multinationals and governments. Who's buying? It's not generally you and me in the first instance, it's going to be your large institutional clients, big pension funds, big life assurance companies, possibly hedge funds and so on and so forth. Okay, and because you might be trying to tap capital in a number of different markets simultaneously, each with their own little quirks. Often what will happen is a big multinational company will bring in an investment bank to help it issue and organise the whole thing, come up with the prospectuses and all that kind of good gubbins, and then actually talk to investors in each of the local markets. And that's where you get what's called loan syndication, and that's a piece of jargon that simply means the bank that's appointed might have to bring in local banks with expertise in particular markets like Thailand or China or wherever it happens to be, to actually organise the kind of sale of bonds to those local investors. All right. So the mechanics tend to be large companies and governments as issuers, investment banks often involved as advisors because the issues can be fairly complex in terms of pricing, timing and getting all the regulatory requirements right. And typically, it's certainly in this situation where you're looking to sort of raise finance for a subsidiary, a sort of fixed interest rate is common on a Eurobond. Because at the end of the day, if you're trying to raise capital for one of your overseas operations, and they might be operating in that country for a number of years, you're going to want to know what interest rate ultimately you're committed to. So quite a few Eurobonds, it's not an absolute rule, carry a fixed interest rate.